Welcome to another deep dive here on the show. Today, we're going to be looking at something that I know is going to be super relevant to all of our listeners out there, especially if you're in the commerce field. And that is, we're going to be taking a deep dive into tax deduction at source, specifically TDS on salaries. And we have, I think, a really impressive amount of material to go over. We're going to be pulling out all the key details, making sure that you have absolutely everything you need.
Absolutely. It's going to be a comprehensive analysis. Our goal is to make sure that we leave no stone unturned when it comes to understanding PDS on salaries.
So we're going to be covering a lot of ground here. We're going to be looking at the broad scheme of TDS, of course, how tax is calculated for, us if we're salaried individuals. And then we're also going to be taking a deep dive into the taxability and valuation of those, sometimes a little bit confusing perquisites.
And that's just the beginning. We'll also be exploring the concept of average income tax and how that's calculated, the implications if you happen to have salary coming from multiple employers during the year, and even the relief that's available if you're paid in arrears or in advance.
And there's even more. We'll be diving into the world of house property income, how that interacts with your salary, and the ins and outs of adjusting for any excess or shortfall of TDS that might happen. And finally, we'll be tackling the unique rules surrounding salary paid in foreign currency. So let's get right into it.
Let's start by establishing a good understanding of the overall TDS system. The way TDS works is that the tax is actually deducted right at the source of income in this case, when your salary is paid by your employer, instead of waiting until the end of the financial year for you to figure it all out on your tax return. It's a system where your employer essentially acts as the government's tax collector, right at the point where your income is generated.
So rather than us as employees individually figuring out how much to send to the government each month, it all goes through our employer. Why is that? What's the main reason for this system?
There are actually a couple of really important reasons why this system is in place. The first is that it ensures a steady and consistent stream of tax revenue for the government throughout the entire financial year. You can imagine that it's much more efficient for the government to be receiving tax money throughout the year rather than in one big lump sum at the end. And then the second key benefit is that it spreads the tax liability for employees across the year, making it a much more manageable process.
Yeah.
Instead of having to come up with a huge amount of money at the end of the financial year, you're paying it gradually in smaller chunks.
Makes sense. So it helps the government by giving them a consistent flow of funds, and it also helps us by making our tax payments more spread out and manageable. So in this TDS system, what exactly are the main things our employers obligated to do? They're the ones actually deducting the tax from our paycheck.
Right. That's right. The employer, who in this context is called the deductor, has several important responsibilities. First off, they're required by law to deduct TDS from your salary if the estimated annual salary you're going to earn exceeds the basic income tax exemption limit that applies for that financial year. This isn't optional. It's a legal obligation.
And I'm assuming it goes beyond just simply deducting the tax. What else are they responsible for handling?
They're responsible for the whole TDS show, start to finish. That begins with them figuring out your total estimated tax liability for the entire year. They do this by projecting your income based on your salary structure and any other taxable components you might have. Then, based on that estimate, they have to deduct the right amount of tax from your salary each month or whenever you get paid. And maybe most importantly, they have to send that tax money directly to the government, following the specific deadlines outlined by the tax rules.
So they're like the middleman, collecting the tax from us and sending it to the government. What about us employees? What's our role in this whole TDS system?
You, the employee, who is referred to as the deductee, are still responsible for paying income tax on your salary. The TDS system is basically a way of collecting tax in advance. That means the tax that your employer deducts each month is treated as if you've already paid it towards your total tax liability for the year. Then, when you file your income tax return at the end of the year, this prepaid tax is adjusted against your final tax liability.
So it's like making installment payments on your tax throughout the year. Earlier, you mentioned how the employer has to figure out our estimated income and tax liability. How do they actually go about doing that at the beginning of the financial year? It seems like a complicated thing to predict.
Well, it is a critical step in the process, and it happens right at the start of each financial year. The employer has to take into account several factors to make this projection. We'll start with your basic salary, of course, but they also have to consider things like any allowances you're receiving. For example, dearness allowance, or DA, which is meant to help with the rising cost of living, house rent allowance, or HRA, to help with accommodation expenses, and conveyance allowance for your travel costs to and from work. They also factor in any perquisites that you might be getting, which we'll discuss later in more detail, and any other taxable income that's part of your compensation package.
Okay, so they make a forecast based on what our salary looks like. But what about things that can change during the year? What if we make investments that qualify for deductions, or are there other deductions we could become eligible for? How is that factored in at the start of the year?
This is where you as the employee have a really important role. Employers need you to formally declare any deductions you plan to claim under Chapter 6A of the Income Tax Act. These are deductions for various investments and expenses that can reduce your taxable income. For example, investments in things like life insurance corporation or LIC policies, the Public Provident Fund or PPF, and the Employees Provident Fund or EPF all fall under Section 80C. There's also Section 80D for medical insurance premiums and a whole host of other deductions that are available. The employer will use these declarations, along with any supporting evidence you can provide at the start of the year, to get a more accurate estimate of your taxable income. They'll also consider exemptions you might claim, like the exemption for house rent allowance, HRA, or the leave travel allowance, LTA, if you're traveling within India, all based on the rules in the Income Tax Act.
So it's like a two-way street at the beginning of the year. The employer makes their best estimate based on your salary, and then we provide information about any deductions and exemptions we plan on claiming. After all that's settled, how does the actual monthly deduction from our salary work throughout the year?
After the employer has determined your estimated annual tax liability, they generally divide that amount by the number of remaining months in the financial year. This gives them the figure that needs to be deducted from your salary each month in equal installments. But keep in mind, if there's a big change in your income during the year, maybe you get a promotion, or if there are changes in your deductions, the employer can and should adjust your monthly deduction to make sure the right total amount of tax is deducted by the end of the year. This could mean increasing or decreasing the monthly deduction in the remaining months to align with any revised tax liability estimates.
That makes sense. There's a way to adjust if things don't go exactly as planned. Now, once the employer deducts the tax from our salary every month, where does that money actually go?
That money doesn't stay with the employer. They have to deposit it directly into the government's account, and they do this through specific banks that are authorized to collect TDS. There are strict timelines for this, usually within a week of deducting it from your salary, and they have to use a specific form, Challenge 2A1, for making these TDS payments. If employers don't do this correctly and on time, they can face penalties from the income tax department, so they're usually very careful about it.
Okay, so the government gets their tax revenue regularly throughout the year, but what about us? How do we keep track of how much has been deducted from our paychecks throughout the year?
You get a very important document from your employer that details all of this. It's called the TDS certificate, specifically Form 16, and employers are required to provide this to each employee once a year, typically by June 15th of the year after the financial year in which the income was earned. Think of Form 16 as your annual TDS statement. It shows your total salary for the entire year and the total TDS that your employer deducted. This form is absolutely essential when it's time to file your own tax return because it gives you all the details you need about your TDS to claim credit for it.
Right, Form 16 is like our official proof of how much TDS we paid. I believe the employer also has reporting obligations to the income tax department directly as well.
Yes, that's right. On top of giving you Form 16, employers also need to submit TDS returns to the income tax department every quarter. This is done using Form 24Q. It's basically a consolidated report of all the TDS deducted from all the employees' salaries during that quarter. It includes all the important details like each employee's PAN, their salary, the TDS amount, and other relevant information as required by the tax authorities. This is another one of those things that employees have to be very meticulous about. Getting these TDS returns submitted correctly and before the deadline is crucial.
So to sum it up, the employer takes care of deducting the tax, sending it to the government, issuing us a TDS certificate, and filing returns with the tax department. That's a lot. And then when we go to file our own tax return, how do we actually get credit for all the TDS that was already deducted?
When you're filling out your income tax return, you'll be reporting all your income and then calculating your total income tax liability based on the tax rates and rules that apply to you. And that's where the TDS comes in. You claim credit for the total amount of TDS that was already taken from your salary during the year, and that information will be on your Form 16. If the total TDS taken out was more than your actual tax liability for the year, then you'll get a refund from the income tax department for the extra amount.
It's all starting to come together now. That's a really clear overview of how TDS on salaries works as a whole. So now that we've got the big picture, let's get down to the nitty-gritty of the process. How is our actual tax liability calculated when we're salaried individuals?
When it comes to calculating your income tax, if you're a salaried individual, there's a very systematic and sequential process that's followed. And the first step in this process is for your employer to figure out your gross salary for the whole financial year. This figure includes absolutely everything you earn before any deductions or exemptions are taken into account. This means your basic pay, along with any allowances you receive, like dearness allowance, DA, house rent allowance, HRA, and conveyance allowance.
So it's like the grand total of everything we earn before we start factoring in anything that can reduce our tax, right?
Exactly. It's everything you've earned before any tax adjustments. And it doesn't stop there. On top of those basic components, we also need to include things like any bonuses you might have earned, commissions or fees you've received, as well as any taxable portion of retirement benefits like gratuity or pension, and absolutely anything else you received from your employer as part of your compensation.
Okay, so we've got the gross salary, which is like the starting point. What's next?
The next important step is to identify any allowances you receive that are specifically exempt under Section 10 of the Income Tax Act. These are special allowances that the government has decided are either completely or partially exempt from income tax, as long as you meet certain criteria laid out in the Act and the amounts don't go over specified limits.
Can you give us some of the most common examples of these exempted allowances? I'm sure a lot of us have heard of them, but maybe aren't exactly sure how they work.
Sure, there are a bunch of them that apply to many people. One of the most common is the house rent allowance, or HRA, which helps cover the cost of renting a place to live. But the amount you can actually exempt from tax is calculated based on a specific formula, and that formula depends on a few things. The HRA you get from your employer, your basic salary, how much rent you're paying, and even which city you live in. Then there's leave travel allowance, or LTA, which is meant to cover travel expenses for you and your family within India. This is also potentially exempt under Section 10, but again, there are rules about how often you can claim it and what kind of expenses are covered. Conveyance allowance is another one, and to the extent that it's for your actual work duties, it's generally exempt. There are also exemptions for things like medical allowance, usually with a limit, or reimbursement up to a certain amount for medical expenses. And if you have kids, there's children's education allowance and household expenditure allowance, both of which have limits per child. It's important to remember that this isn't even all of them.
There are a bunch of more specific exemptions under Section 10 that might apply depending on your individual situation and job.
So essentially, the first step is to calculate our gross salary, and then we look for any of these specific exempted allowances under Section 10 that we can subtract. Is what's left after that the part of our salary that's going to be taxed?
Yes. Once you subtract all the allowances exempt under Section 10, what you have left is called your net salary, or taxable salary. Pretty simple. Taxable salary equals gross salary minus total exempted allowances under Section 10.
Got it. Now, how do perquisites fit into this whole calculation of our taxable income?
After you figured out your net salary, the next thing is to add in the taxable value of any perquisites your employer gave you during the financial year. Perquisites are basically any kind of benefits or extras your employer gives you on top of your regular salary. They could be things like a company car for personal use, club memberships, rent-free accommodation, medical facilities, or even concessional loans. These are all considered perquisites.
Right. It's all those benefits beyond just getting our salary every month.
Exactly. The key thing to remember about perquisites is that they usually have a monetary value assigned to them for tax purposes, and those values are added to your net salary. This brings us to a figure we can broadly call your income from salary. But that's before we factor in any deductions allowed under Section 16 of the Income Tax Act. We'll get to those next.
Perfect. So we've got our income from salary before we consider those Section 16 deductions. What's the next step in figuring out our final tax liability? I know there's a standard deduction that's available to most salaried people.
You're right. Under Section 16 deduction of the Income Tax Act, there's a standard deduction that you can claim from your income from salary. For the financial year 2023-24, this deduction is set at 50,000 teraquarters. It's a fixed deduction, which means almost all salaried individuals can claim it regardless of their expenses. To calculate your income from salary after this deduction, you simply subtract that your income from salary before standard deduction, and that gives you your income from salary after standard deduction.
I think I've also heard of a couple of other deductions that are allowed under Section 16, but I'm guessing they apply in more specific situations.
That's right. There are two more deductions under Section 16, but they're less widely applicable. One is the deduction for entertainment allowance under Section 16, but this one is only for government employees, and it has certain conditions. Then, under Section 16.3, you can deduct any tax on employment, also known as professional tax, that you've actually paid in the previous financial year. This is a tax some states levy on people who earn a salary or are self-employed professionals.
So those are some extra deductions to keep in mind, but they might not apply to everyone. After all of this, we finally got a number for our income from salary, taking into account those Section 16 deductions. Now, how do we factor this into the bigger picture of calculating our total tax liability for the year?
Now we need to figure out your gross total income, often called GTI for short. GTI is basically the sum of all the income you've earned from all the different categories of income the Income Tax Act defines. If you're a salaried person, this is definitely going to include your income from salary after all those Section 16 deductions. But it could also include income from other things, like income from house property if you're renting out a property, or if it's considered deemed to be let out, profits and gains of business or profession if you're running a business or working as a professional, capital gains from selling any capital assets, and income from other sources, which is kind of a catch-all category for income that doesn't fit into the other four. But honestly, for a lot of people who mainly get income from their salary, the gross total income is basically going to be the same as their income from salary after those Section 16 deductions, unless they have income from those other sources as well.
So basically, GTI is like the big pot of all our income before we factor in those bigger, broader tax deductions. And I believe those are the deductions we claim under Chapter 6 of the Income Tax Act, right?
Exactly. Once you've figured out your gross total income, you can claim any deductions you qualify for under the various sections within Chapter VA. These are essentially deductions from your GTI that help you arrive at your total income. Your total income is the final income figure that's used to calculate how much income tax you actually owe. If you're claiming these Chapter CA deductions, it's super important to give the necessary declarations and proof to your employer, and later when you file your tax return, to back up those claims.
Can you remind us about some of the most common Chapter of VA deductions that are especially relevant for people with salaries?
Sure. One of the biggest and most widely used deductions is under Section 80C. It covers a whole range of investments and expenditures the government wants to encourage for various reasons, like saving for the future. This includes things like your contributions to Life Insurance Corporation, LIC for premiums, Public Provident Fund, PPF, Employees Provident Fund, EPF, investments in National Savings Certificates, NSC, and Equity-Linked Savings Schemes, ELSS. And it even covers the principal portion of your home loan repayments and tuition fees for your children's education. But there's a catch. You can only claim up to 1.5 lakhs in deductions under Section 80C for the whole financial year. Then there's Section 80CCD 1B, which lets you deduct an extra 50,000 Bormar for contributions to the National Pension Scheme, MPS, and that's on top of the 1.5 lakhs under Section 80C. Section 80D is for deducting the premiums you pay for medical insurance for yourself, your family, and your parents, and even for preventive health checkup expenses. If you've got an education loan for higher studies, the interest you pay on that loan might be deductible under Section 80E. And then there's Section 80G, which allows you to deduct donations you make to certain charities and funds that are approved by the government. And there's even more beyond these. There are other Chapter VIA deductions that could apply to you depending on your finances, like deductions for interest on savings accounts under Sections 80TTA and 80TTB, for medical treatment expenses for specific diseases under Section 80DDB, and a bunch of others.
Okay, so after we take away those eligible Chapter 6A deductions from our gross total income, what we have left is our total income. Now we can actually calculate how much income tax we need to pay for the year, right?
Exactly. Once you know your total income, you can calculate your income tax liability. And this calculation depends on the income tax slab rates that are in effect for the specific year and what category of taxpayer you are. For example, there are different rates for people under 60, senior citizens who are 60 or older but under 80, and super senior citizens who are 80 or older. Plus, you have to factor in which tax regime you've chosen for the year. You could choose the old tax regime, which has more exemptions and deductions like the ones we've been talking about, or the new tax regime, which is simpler with lower tax rates, but you can't claim as many exemptions and deductions. Your choice of tax regime can make a big difference in how much tax you owe.
Right, so it's not just one flat tax rate for everyone. It all depends on our income, age, and which tax regime we choose. And then on top of that, I think there's also the surcharge and the health and education cess that we might have to add on, right?
Yes, you're absolutely right. If your total income is above a certain level, you'll have to pay a surcharge in addition to your regular income tax. The surcharge is a percentage of your income tax, and the percentage goes up as your income goes up. It's basically an extra tax for people with higher incomes. And then on top of the income tax and any surcharge, there's the health and education cess, which is 4% of your income tax, plus surcharge. This cess is specifically used by the government to fund health and education programs.
So we add any surcharge and the health and education cess on top of our income tax. Are there any ways to potentially reduce our tax liability at this point? I've heard something about a rebate under Section 87A.
You're right, there is something called a rebate under Section 87A. It's basically a way for some people to reduce their income tax. If you're a resident individual and your total income is less than a certain limit, you can claim this rebate, and it can actually lower your tax liability by a certain amount, which changes depending on what the government decides each year. This is a break that's aimed at helping people with lower incomes.
So it's like this. We start with our income tax, then add the surcharge and the health and education cess if they apply, and lastly, we see if we can get any reduction with the rebate under Section 87A. Whatever we're left with after all of that is what we really owe, right?
Precisely. That final amount is your net tax liability for the year, and it's what your employer ideally would have deducted over the year through the TDS mechanism. To calculate the monthly TDS deduction, your employer will generally take your estimated net tax liability and divide it by the number of remaining times you'll be paid in the financial year. That's how they decide how much to take out of each paycheck.
Wow, that was an incredibly detailed breakdown of how our tax is calculated. It definitely makes it clear that while the basic concepts might seem kind of simple, the actual process can get really complex, especially when you factor in all those allowances, perquisites, and all the different deductions we might be eligible for.
You're absolutely right. What we've discussed is still a bit of a simplified explanation. Real life can be way more complex. It all comes down to each person's unique income, investments, and financial dealings. That's why employers often rely on sophisticated software to get it right, and why many people turn to tax experts to make sure they're compliant and to help them plan their taxes better. And as we talked about earlier, it's super important to remember that tax laws, those income tax slab rates, and the rules around deductions and exemptions, they all change every year based on what's in the Finance Act and the various circulars from the tax authorities. It's a dynamic system, so keeping up with the latest changes is crucial for everyone, both employers and employees.
Yeah, it's definitely important to stay on top of all those changes. Now, I think it's time to take a deeper dive into perquisites. We mentioned them earlier when we were talking about calculating gross salary, but they've got their own set of rules and regulations when it comes to how they're taxed and valued. Just to refresh our memories, can you remind us again exactly what is meant by a perquisite when we're talking about income tax?
Sure. Remember those extra benefits and amenities your employer provides on top of your regular salary? Well, those are perquisites. They can be all sorts of things, like a company car you get to use personally. They might pay your club memberships, give you rent-free or subsidized accommodation, provide medical facilities, or even offer you loans at really good interest rates. They can also be in the form of cash payments or reimbursements for things you've spent money on.
Okay, so it's basically anything extra we get from our employer beyond our salary. So are all these perquisites automatically added to our income and taxed?
For the most part, yes. Perquisites are usually seen as part of your total compensation package and are therefore taxable, just like your salary. But there are some exceptions. The Income Tax Act has a few provisions that specifically exempt certain types of perquisites under certain conditions. How a particular perquisite gets taxed and how its value is calculated for tax purposes depends on what type of perquisite it is, and sometimes even on your specific category as an employee.
You just mentioned that sometimes the taxability depends on our category as an employee. Can you clarify what that means?
When we're trying to figure out if a certain perquisite is taxable, employees are generally split into two categories: specified employees and non-specified employees. A specified employee is someone who falls into one of these categories. They're a director of the company, they have a substantial interest in the company, which basically means they own a significant chunk of the company's voting power, usually at least 20%, or their income from salary, excluding any perquisites, is over $50,000 for the year. If you don't fall into any of these, you're considered a non-specified employee. And why does this matter? Well, some perquisites are taxable for everyone, specified or not, but others are only taxable if you're considered a specified employee, so it's important to know which category you're in.
Okay, that makes sense. Let's go through some of the most common types of perquisites and see how they're valued for income tax. What about rent-free accommodation? I'm sure that's a big one for a lot of people.
Yes, rent-free accommodation, or RFA, is definitely a common perk and can be pretty valuable. How it's valued for tax purposes can be quite a bit complicated and depends on a few things, like whether your employer owns or leases the place, and if it's furnished or unfurnished. For unfurnished accommodation that's owned by the employer, the valuation method depends on whether you work for the government, either central or state, or if you're in the private sector.
Yeah.
If you're a government employee, the taxable value is usually just the license fee set by the government. But if you're not a government employee, how much of your salary is taxable depends on the population of the city where you live. If your city has more than 25 lakh people, you'll have to add 15% of your salary for that rent-free accommodation. Between 10 lakhs and 25 lakhs, it's 10% of your salary, and below 10 lakhs, it's 7.5%.
When you say salary in this context, what exactly are we talking about? Is it just our basic pay?
When we're figuring out the taxable value of rent-free accommodation, the term salary has a specific meaning. It includes your basic pay, any dearness allowance, DA, even if that DA isn't part of your retirement benefits, all your other taxable allowances, the taxable value of any other perquisites you get, and any bonus or commission you earned. But it doesn't include things like your employer's contribution to your provident fund or any allowances that are exempt from tax under Section 10.
Okay, so it's a pretty broad definition of salary when it comes to this. What if the accommodation isn't owned by the employer? What if they're just renting it and then letting us stay there for free?
If the accommodation is leased by your employer, meaning they're the ones renting it, and they give it to you rent-free, then the taxable value is either the actual rent your employer is paying or 15% of your salary, whichever is lower.
And what if the place is furnished? Like it has furniture and appliances and things like that?
If it's furnished, there are two parts to calculating the taxable value. First, you calculate the value of the accommodation as if it was unfurnished, based on either the population of the city or that lower of rent or 15% of salary rule. Then you add to that 10% per year of the original cost of all the furniture and appliances if your employer owns them, or if the furniture is rented, you add the actual rental cost. So it's the value of the unfurnished accommodation plus the value of all the furnishings. That's how you get the total taxable value for furnished rent-free accommodation.
Makes sense. Now let's move on to another perquisite that a lot of people probably get, a company car. How's that valued?
Ah, yes, the company car. The valuation of a motor car, or other conveyance, as it's officially called, also has its own set of rules under the income tax rules. Like with accommodation, several factors influence its valuation. For instance, who owns or leases the car and how you're using it. If your employer owns or leases the car and you only use it for official purposes, it's not a taxable perquisite, as long as you keep good records of your official use, just in case there's an audit. But if you only use the car for personal stuff, then the taxable value includes the cost of running the car, plus 10% depreciation each year on the car's original cost if your employer owns it, or the lease charges if they're leasing it. And if the employer provides a driver, you also have to add the driver's salary.
What about if we use the car for both work and personal stuff, which I'm guessing is the most common situation?
That's where things get a bit simpler, actually. If you use a company car for both work and personal use, there's a fixed value that's added to your taxable income as a perquisite. The value depends on how big the engine is. For cars with an engine up to 1.6 liters, it's $1,800 a month if the employer pays for all the running costs, or $900 a month if you cover the running costs. If the engine is bigger than 1.6 liters, it's $2,400 a month if the employer covers the cost, or $900 if you do. And in both cases, if the employer also gives you a driver, you have to add another $900 per month.
What if we use our own car for work and the employer reimburses us for the expenses? How does that work tax-wise?
If you're using your own car for work and get reimbursed by your employer, the reimbursement for official use is usually not taxable as long as you have good records to prove it was all for work. But if any part of that reimbursement was for your personal use of the car, then that part might be considered a taxable perquisite, and they'll calculate its value based on the same rules we talked about for company cars used for personal reasons, taking engine capacity and who's paying for running costs into account.
All right, that makes sense. What about something like interest-free or concessional loans that we might get from our employer?
So when your employer gives you a loan without any interest or at a really low interest rate, there's a limit. If the total amount of all these loans you've taken from your employer is less than $20,000, it's not taxable. But if it's more than $20,000, then you have to calculate how much interest you would have paid if you had taken a similar loan from the State Bank of India, SBI, on the first day of the financial year. You then deduct whatever interest you actually paid on your employer's loan, and the difference is the taxable amount. There are some exceptions to this rule, though. For instance, if you took the loan for medical treatment for certain diseases, or if the loan amount is considered small, it might not be taxable, even if it's over $20,000. But you have to look into the specific rules to be sure.
All right, I'll keep that in mind. How about things like gifts, vouchers, and tokens?
Yes, gifts, vouchers, and tokens are also considered perquisites. It depends on the total value of these you've received from your employer during the year. If the total value is less than $5,000, it's not taxable. But if it goes over $5,000, the whole amount becomes taxable as a perquisite, not just the amount that exceeded the limit.
Wow, it seems like all sorts of things are considered perquisites, and those rules about how much is taxable and how to calculate the values can be quite tricky. Are there any tax-free perquisites?
Of course, there are actually quite a few perquisites that are specifically exempt from income tax under the Income Tax Act and rules. These include your employer's contribution to your recognized provident fund, RPF, but the exemption is limited to 12% of your salary. Some medical benefits provided by your employer, either up to certain limits or through approved medical schemes, are also generally tax-free. Leave travel concession, LTC, to travel within India is exempt, but there are rules about how often you can claim it and what kind of travel qualifies. Your employer providing you with a computer or laptop for work or personal use is generally not taxed. Same goes for telephones and mobile phones provided by your employer. And the interest your employer pays on certain loans they might give you could also